So this week we're talking about simple mortgage loan. Um, this is very similar to the car loans that we talked about last week, but we have a significantly longer maturities and a little bit lower interest rates, and we have the house as the collateral. In the car loan, we had the car as the collateral for the loan. Now we have the house as the collateral, so the amounts are significantly bigger. And So the type of interest rates for the mortgages are very similar to consumer loans and the car loans. It can be a variable interest rate and it can be a fixed interest rate. But what you need to understand is that for the mortgages, you have a significantly longer period for the loan. We're talking about 30 years, which is a very typical house mortgage. And if you actually take out a variable interest rate, you really don't know what's going to happen within the next 30 years to that interest rate. We are talking about a 30-year planning period. Nowadays, for instance, interest rates are historically low. We're talking about maybe 3 or 4% mortgage interest rates. And going forward, could they go down? Obviously, they can, but they also can go up. So variable interest rate exposes you to a risk of these interest rates going higher, and therefore you end up paying higher interest cost on your mortgage loan. A fixed interest rate, well, you know what you're getting into from the get-go. For the next 30 years, you're fixed into that interest rate, and interest rates can go down, so you may be remorseful, you may regret that you actually took a fixed interest rate. But on the other hand, you actually know what your interest rate will be for the next 30 years. And like I said, nowadays the interest rates are very, very low. So having a fixed interest rate nowadays may be something that will be considered. Um, Obviously, interest rates can also go down. So it is a choice, but you should know that with the variable interest rate will change, certainly up or down. And the fixed interest rates, your interest rate that you signed up today will be the interest rate that you actually end up paying 30 years from now. Typical length for a mortgage is 10 plus years. In fact, what's most common is 30 years. Um, it is also very common to have 20 years or 15 years, but most definitely 10 plus years. In fact, motorhomes, RVs, they seem to have these types of mortgages, and they can be about 10 years or 15 years. But even for a common ordinary um, dwelling, you could actually have a 15-year mortgage. Your premiums would be higher, but the interest that you pay would be, in total dollar amount, would be lower. If you can afford it, then a 15-year would actually, you end up paying in total less interest rate, less interest cost. But typical length for a mortgage is 30 years. And if you sit around a table with a loan broker, they will probably assume that you're there to get a 30-year mortgage loan. We talked about amortization before, and this is very much the same, but I actually draw a little bit of a schedule for this one because we're talking about a 30-year mortgage. Beginning of the loan, you definitely pay most of your payment goes towards the interest. And at the end of the loan, most of your payment goes to the principal. So this is an example. I didn't do it on a monthly. Most mortgages are paid on a monthly basis, but I actually did this for a 30-year loan, mortgage loan, and just for so that I could fit it into the screen. I took an interest rate of 4%. And what I did is started out with $100,000. So, for $1 million, for instance, you just add a zero. So for a principal of $100,000, accrued interest for every year will be the interest rate based on the outstanding balance. So when we start out at $100,000, your accrued interest for the first year will be approximately $4,000. This is an introductory course, so I didn't go into the specifics of APR and APY, and on a monthly basis, this actually compounds a little bit more. But for the purposes of this course, those details will be a few dollars, maybe 10, maybe $15 a month or so. So the general idea is very clear with an annual calculation. So for the balance of $100,000 for the first year, the interest will accrue at the 4%, which will be $4,000. Now, what's common with a mortgage payment is that you actually have a fixed monthly payment. And like I said, this example is for an annual payment, but what's common is that you actually have a monthly payment. And it's a fixed amount. What you pay today and what you pay in 15 years or 20 years and 30 years will be the same, except there will be some slight changes we'll talk about in a minute. With respect to the payment schedule, it will be the same. So what happens is, based on these numbers, 30 years, 4%, $100,000, you're going to end up paying $5,783 and a penny. And that's an annual payment. Now, notice how off that 5,700, $4,000 of it goes to interest. See, off the $5,783 that you pay for the first year, you're actually paying $4,000 of an interest. The second year, your balance goes down as much as that difference. So the second year, you actually paid it down about $1,783. So you now have an outstanding balance of $98,000 and change. Now, 4% accrues on the outstanding balance. You make the same payment, but now you're paying $3,928 as an interest. Now, if you go to the 30th year, your outstanding balance will be, 5,560, and the interest that accrues on this will be whatever the 4% off the outstanding balance is, which is $222. You make the same payment of $5,783, of which only $222 goes to the interest, and the rest will pay the principal. So going back, monthly payments are mostly interest at the beginning of the loan, right, like this, off the 5,700. $4,000 is actually paying for the accrued interest. And at the end of the loan, monthly payments are mostly the principal. Off the 5,783, $222 is interest. Remainder goes to the actual principal. Now, based on the amount of the principal that you started out with and how much you paid it down is referred to as equity in the house. So for instance, in the first year, your equity in the house is about $1,783. The second year, your equity is about $4,000. Fourth year, your equity is about $5,500. Fifth year, your equity is about $8,000, and so on and so forth. So why is this important? Well, for insurance purposes, it will be important. I'll talk about it in a minute. So that's what we refer to as amortization. And you should know that you can actually pay interim payments. If you have, say, a bonus payment, or you receive some sort of a payment from, you get a lottery ticket, and then you win $10,000 of lottery, that sort of thing. You can actually make a payment in the middle, and then you can request your mortgage company to recalculate the remainder of your mortgage and give you a new payment amount, which will be lower now. So not every mortgage will allow you to make early payments, but you need to make sure that when you're actually signing up for a mortgage, that you know all the conditions of the mortgage, and they do allow you to make early payments. And then, in fact, if you have, if you can, making a additional payment now and then could lower your cost. The amount of interest that you pay will go down as you make interim payments, voluntary payments, right? So notice how much interest you're paying for this. This is a whole lot. That's 4,000, 7,000, 10,000, That's another 10. I mean, you're paying a whole lot of interest just for this mortgage. So if you can actually pay this early, it would save you from that interest cost. So there are some other required payments that you have to make along with your mortgage payment. So when you buy a house, your mortgage broker and your legal team, during the closing, you will actually have a title transferred from the seller to you. They will actually give you a payment schedule. Now, that payment schedule will interest the mortgage actual mortgage payment, uh, but then it will also include items like homeowners insurance premium and the property tax, and then in some cases, some other payments. So people usually refer to the mortgage payment as that one single check that you write at the beginning or at the middle or at the end of the month, but once a month. And then you basically thinking that that's it, that's your mortgage payment. You should know that that's actually mortgage payment plus your homeowner's insurance premium and then your property tax. A lot of people overlook how much homeowners insurance they're paying and how much property tax that they're paying, and they do not make sure that it's very common to skip this, that people don't make sure that homeowners insurance is actually paid and the property tax is actually paid. So the way it works is that you write a check, you send it to your mortgage company, whichever it could be a bank, it could be a financing company, it could be a financial institution, like a credit union. So that check will be an amount, a fixed amount. Say in this case, for an annual, for instance, it will be like $6,000 or $7,000, a little bit more than this. And some of that payment will go towards the mortgage, like the mortgage payment that we talked about. And then some of them will go into what we refer to as escrow account, which will be like almost like a savings account, but you keep it at the mortgage company and you can't withdraw that money. The money will accumulate there. And then from that account, your mortgage company will make a payment towards the homeowner's insurance, and they will also make a payment to your municipality for the property tax. Some mortgage companies can skip this. They may delay this. There may be penalties. It is your obligation to check them. Your municipality will not bother with the mortgage company. They will just send you the bill. And if things go bad, like mortgage company files for bankruptcy and stuff like that, you might actually find out that the mortgage company didn't pay the homeowner's insurance or the mortgage company didn't pay the property tax. It is your obligation to make sure that they do. So how do you do that? Well, just make sure that you know where your insurance papers are, what your cutoff for your date is for your homeowner's insurance. And then after the cutoff, you give them a call to make sure that your account is paid and then there's no outstanding balance. Same thing with the municipality. Most municipalities will have an online service now that you could just log in and check if your property tax is being paid. It really is a problem when you receive a notice from the municipality that says that you didn't pay your property taxes, because it will include a penalty in it, and your mortgage company will not pay that penalty. So the escrow account, now remember I said this $5,783 is fixed. Now that's your mortgage payment. That is fixed. No question about that. But on top of this, you actually pay homeowners insurance premium, which will increase every year, and you will pay a property tax, which will also increase every year. So the amount of mortgage or amount of monthly payment that you make will change, but the change will be based on the homeowner's insurance and the property tax, not your mortgage payment. And like I said, we use that mortgage payment very loosely. Most people will refer to that one payment that we write a check for that includes your mortgage payment and your homeowner's insurance and the property tax. Now, again, because people are writing one check, They also don't look into the homeowner's insurance premium. Now, this is really your mortgage company making sure that you have a homeowner's insurance. And the mortgage company is making sure that you are paying your property taxes because, after all, you own the house, but the house is the collateral for the loan. So they want to make sure everything is legit with the house. So, however, it is your insurance. You can actually change your insurance company, what is covered in your insurance. And in fact, when you're signing up for a mortgage with a mortgage broker or with an insurance dealer, what happens is you may not think that you have a choice. You may be, directed into a insurance that is very expensive, and because you're making monthly payments, you may think that it is part of the mortgage, but you should really have a breakdown of how much mortgage you're paying, how much insurance you're paying, and how much property tax you're paying towards your escrow account. And you have a choice of changing your homeowner's insurance within the guidelines of the mortgage company. Mortgage company may not accept every insurance. They may not accept the limitations that you have, the amounts that you set. However, you have quite a bit of room. You don't have to go with the maximum, and you may have deductibles and that sort of thing. So, but you should check to see how much money you have in your escrow and if your mortgage company is actually paying the homeowner's insurance and the property taxes. So, most periodic payments for mortgages are made monthly. You can actually choose when you make that monthly payment. Most mortgage companies will let you choose even a date. I want to pay on the 7th of the month, the 10th of the month, depending on when you get your paycheck, depending on when you feel like, paying, the middle of the month, end of the month, beginning of the month. But it would be really nice if you could make voluntary weekly payments. I keep saying this. I know it may not be, easy, but if you actually keep making these weekly payments, just because you have a little bit of a surplus in your budget, in a couple of years you will feel the difference in your mortgage, and then you can call your mortgage company and request them to change your monthly payments, and your monthly payments will go down. And remember, the sooner you actually lower this principal that you owe, the sooner your accrued interest goes down, and the sooner you start paying towards your principal rather than just paying the interest. The first few years of a mortgage are horrible because you really end up paying most of the payment that you make goes towards paying the interest. So the sooner you can actually lower this down, will better for you. You actually pay less interest. Now, early payments obviously may be allowed with no penalty, but some mortgage companies may require a penalty payment. They don't like you to make an early payment. Remember, this is how much money they make. If you pay this down early, then they don't make this money. So they really don't want you to make that payment. They want you to stick to the schedule, and they want you to pay that. And as soon as you pay that, they're happy. But if you start paying more, then you basically are lowering your principal, and they're losing business. So sometimes some mortgages may not allow you to make an early payment. It may be in your loan agreement, or they may require a penalty. You paid $100. Okay, so there's a $20 early payment fee. So off the 100, we'll accept an 80, and then 20 goes to a fee. So it's not fair. But if it is in your loan agreement, it is what it is. So you have to make sure that you know what you're signing into. And then this is a 30-year commitment. The car loan was a 5 years or 7 years. This is a 30-year commitment. You should know what you're reading into, signing into. You should read your document. You should read your conditions. Can you close it early? Can you pay it down early? Can you make a voluntary payment? Everybody gets a promotion once in a while, and then you actually get a bonus payment. You get married, and your parents give you some gifts. They write you a check for a few $1,000s. You really win the lottery, get a $10,000 bonus, and then you want to pay that down, and then the mortgage company says no, you can't. So let's make sure that you actually sign the loan documents after thoroughly reading them and understanding what they actually mean. In my opinion, you should also, um, opt for a mortgage payment that is suitable to your financial situation rather than what they want you to sign. So the insurance requirements for a mortgage loan can be extensive. Your mortgage company, remember, your house is the collateral for the mortgage loan. So they will require you to have a homeowner's insurance, which must include liability damage. So the liability is, somebody slips in the front yard and they sue you. So you need to have some sort of a liability coverage. Damage to the house, hail, hurricane, uh, fire, thefts. I mean, everything can happen to a house. It's a, um, you know, steady building. It's not moving anywhere, but that things can actually hit it. So you need that insurance, and you're required to have that insurance. Although the amount can be excessive, so it is up to you to make sure that you actually have a homeowner's insurance that's suitable to what you need. For instance, in my experience, um, I bought a house, a couple of decades back. It was about $130,000, and and the insurance on it was over $250,000. And then I called the insurance company and said, "Look, the house is $130,000. How come the insurance is 250?" They said, "Well, our lowest is 250." I'm like, "Do I have to work with your like specific insurance company?" And they were like, "No." Then I called another insurance company, and the premiums that I had paid were actually, reduced more than half. So you should make sure that the homeowner's insurance that you're getting is exactly what you need, no more, no less. Depending on where you live, you may need a flood insurance, hurricane specific insurance. Um, and the flood insurance can be excessive, but they're also subsidized. So you can also grandfather into a flood insurance that was owned by the previous owner for the specific dwelling. Be careful with the deductibles. There may be different deductibles for different things. Like I said, in my own experience, I found out that if there's a hurricane, there's a different deductible for your roof, and there's a different deductible for everything. It turns out. So don't assume that when you're negotiating for a $2,000 deductible, that's it. You get a 2,000 deductible for everything. It really is not. Get a breakdown of what deductible for what damage. Deductible for the liability will be significantly different than the deductible for the damage, deductible for flood, and deductible for specific occasions. For instance, act of God, storms, hurricanes, flooding, all of that. So make sure that your deductible, first of all, is acceptable by your mortgage company and acceptable by you. A lot of the times, it may be a good idea, if you can afford it, to have the deductible. Say you have a $2,000 deductible, put a $2,000 into your savings account, that sort of thing. Now, we talked about gap insurance for the car financing. There is, at least not that I'm aware of, no gap insurance for a house. So it becomes a problem, right? So there's something called an underwater sneak peek. So the gap insurance was for a car. You buy the car gets stolen. So the value of the car, or what you get from the insurance, may not cover what you owe on the car, and therefore you have a gap. The gap insurance pays for that gap. With the house, you don't have that, so that becomes a problem. So we'll talk about that in a minute. There's a mortgage protection insurance. This actually is a very much like a life insurance. um, Say you're head of household, and then you, God forbid, you have a heart attack and you die. So what happens to the mortgage? What happens to your family? I mean, they lost their bread earner, and all of a sudden they actually have to make mortgage payments, and if they can't make those payments, they lose the house. um, so a mortgage protection insurance is You can actually buy it separately, or you could make it part of your life insurance. You could have it as a term life, or you could have an accumulating life, which we'll talk about in week number 7. Um, but you can add a mortgage protection, which in the case of death, it actually pays part of your mortgage or all of your mortgage, depending on how much premium you want to pay. But this really is to protect your family in case something happens to the bread earner, to the person who's actually responsible to pay the mortgage. There's also something called a PMI. This is private mortgage insurance. Now, this is actually to protect the mortgage company. You pay for this. So it is funny, as a, you know, person, you pay for the private mortgage insurance. However, this is to protect the mortgage company. Now, the idea is very simple. When you buy a house, there's an expectation that you can put down some sort of a down payment. Um, and a portion of it you actually pay. So, for instance, with the periodic payments, we said $100,000 loan. Let's say the house is $100,000. The expectation is that you can actually pay about $20,000 in cash and then borrow $80,000, right? So about $20,000, um, you are expected to actually pay, and it's very common that when you're buying a house, they may not ask you for a down payment, or they may ask you for a 10%. However, anything less than 20%, the mortgage companies don't feel safe, so they ask you to get a private mortgage insurance. In case you cannot pay, then they apply for the private mortgage to take over the house, the repo, the costs, and everything, so they can get out of the mortgage. So the private mortgage is to protect the mortgage company in case you cannot pay because you actually don't have enough equity in the house, and then you pay the premium for this. So how can you avoid it? Um, Buy a house and try to put down 20% or more, and then borrow the remainder 80% if you can. So if you can't do that, then you probably will be required to get a private mortgage insurance. It's not as expensive, but it's still, to me, it really is disturbing simply because mortgage company is benefiting from this and I am paying for that. But it is what it is. With respect to the gap insurance, right? With the car gets stolen, insurance payment is not enough to pay the loan. What happens in a house? You see, the value of the house versus the outstanding debt. Now, if the value of the house goes down for whatever reason, we have had this in the past in some cities. Some major employer moves out of the area, and then the whole area loses their livelihood, and the housing market crashes and values of the houses go down. So that doesn't mean what you owe on the house is going to go down either. It simply means that you owe, based on our example before, you owed $100,000, but now the house is 50. So now you're in trouble. So this is what we refer to as underwater mortgage. You can't get out of it. So you're underwater, and you may owe more than the value of the house. You can't sell the house unless you pay that difference. You can't refinance unless you pay the difference. You really are stuck. So it becomes a problem. There are a lot of people who are in this situation where the house value is lower than the outstanding debt, and pretty much the only way to get out of it is to pay it down. It's your loss, not the mortgage company's loss. And remember, buying a house is, for most people, the single most or single biggest investment of your life. So be very, very careful with it. So when I bought my house, for instance, for $130,000, all of it was debt. I didn't have a penny in it. Like I couldn't make any down payment in it, and all of it. But still, it was $130,000 of an investment for the with the money that I didn't have. And So if the value of the house were to go down by $20,000, I would have actually lost $20,000 that I didn't have. So just because you don't have as much money in the house doesn't mean that you won't owe it. So, like I said, in my case, the $130,000 house, I didn't have a penny put down on the house. The whole thing was a debt. However, if value of the house goes down, I still owe $130,000 on it. So the underwater mortgage is a significant problem. And our final topic is about refinancing. What does it mean to refinance? So first of all, not every mortgage can be refinanced. And well, let me explain what it is, and then these will make a little more sense. So this is your payment schedule. We have a 4%, and then you start out with $100,000, and this is your payment schedule. Now, let's say that after 5 years you bought the house, the interest rate went down to overall outside, other banks are offering 3%. Now, based on that 3%, now notice how if you were to take it for the first time, the $100,000 on a 4% is a $4,000 interest. On a 3%, that's a $3,000 interest. And it kind of carries forward all the way to that 30 years. And that's a lot of interest difference. So can you actually pay this off, get a new loan, and continue with that one? That's called refinancing. So what happens is you borrow from one company and that's your payment. Now you want to get out of it. Then you actually refinance with a second company. The second company will pay off the first company, give you a payment schedule. So they will, in a way, pay off the existing mortgage, take the lien off the house title, put a new lien on the house title, and set you up with a new mortgage. Now, depending on what you want to do, you could actually start a new 30-year, or you could continue with whatever remaining years that you actually had. So let's say that you had it on year number 9. So you have 21 more years to go. If you refinance, you have a choice. You could actually get a new mortgage all the way to another 30 years, or which would actually mean that you would actually pay a lot of interest. Or you can say, I want to refinance a traditional refinance, and I want to continue with the remainder 21 years. So, having said that, not every mortgage can be refinanced. You have to make sure that your mortgage, when you're signing up, allows you to refinance. That really literally means that you could pay it off early, because your second refinance company will be closing off, paying off the first mortgage and start a new one. So your own mortgage company would not do this. They simply won't be interested in this. This is very much like saying, can I pay you less, please? They will say no. So there really is very little point in talking to your own mortgage company to refinance. Um, I mean, I can think of some situations where the mortgage company, because they don't want to lose you, they may actually give you a price. So they might actually give you, okay, happy to help. We don't want to lose you. Instead of the 4%, we'll give you 3.5. But the likelihood is you probably will be better off shopping for this. You shouldn't just take the word of your current mortgage company and assume that they have your back. They're not a charity institution. They're there to make money off of you. So shop for a refinancing. And notice, by the way, that there are costs involved with refinancing. So, you know, they could give you an interest rate, but there could be $3,000 closing costs or $5,000 blah blah costs. So make sure that you can actually benefit from the actual refinancing. So it really pays to shop for this. Um, Although you have to be careful when you're shopping for it, if uh, the different companies that you ask for interest rates, if they actually get your social security number and check for your credit score, that will hurt your credit score. It will you, because frequent checks to your credit score will hurt your credit um, score. Um, it will be reported on your credit report, and it's not a good thing. So what you can do is you can ask them to do a soft credit report check without hurting your credit score, um, and make sure that you actually do it with a few reputable companies, and then decide which way you want to go. But while you're shopping for it, make sure that you are conscientious about, you know, your credit score with the credit checks. So that's about it for the simple mortgage loan. And remember, this is an introductory course. There's a little bit more to it, like calculating APRs and APYs and the actual interest payments and so on and so forth. But that's for another course. If you have any questions, please do let me know. And thank you. Have a great day.